been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is co-CEO of Recessions Partners, Joe Muratore. Now, Recessions is a commercial real estate investment firm that specializes in large-scale value-add commercial real estate in California's Central Valley. More specifically, Recessions focuses on Central Valley office buildings and shopping centers and currently has over 150 million assets under ownership and 300 million under third-party management. And so, guys, I'm excited to introduce Joe here onto the show. But before we dive into it with him, just have a few quick housekeeping items to run through. I'm excited to announce that our third mobile home park investment fund just went live a few weeks ago. You probably heard me talk about it a few different times. And so we're excited, guys. It's been a couple of years now since we opened up our last offering, or I guess shut down our last offering, however you want to look at it. And so lots of pent-up demand. We've been overwhelmed with interest. As you know, we've been doing this now for nearly 10 years, specializing in the manufactured housing space. This offering, just like our others, is a Regulation D506C, and it's open to all accredited investors. And again, for those that that don't know about me, aren't familiar with my background, maybe this is the first time you're listening to the show. I've been a full-time real estate investor for 2 decades now, 20 years, and have been focused solely on the manufactured housing space for going on 9 years, so going on a decade. And it's a space that years back, folks really didn't have an interest in. They'd kind of snubbed their nose at it. It wasn't all that sexy. It's still not really all that sexy today, but it's an incredibly lucrative investment space. So much so that large groups such as Carlyle, Blackstone, Apollo Group, and many other PE firms have jumped into this space in a very big way and have deployed a great deal of capital to somewhat consolidate this space. And so if you have an interest in getting into this niche with a team with a significant track record and lots of expertise. Again, nearly 10 years of expertise. You can go to our website, investwithsunrise.com. Again, that's investwithsunrise.com. And there on that site, you can find our most recent webinar that goes through the most current offering that we have available, and also access our PPM and offering docs. And we've got a number of exciting off-market opportunities available in the pipeline. And so just very excited to move forward and look forward to hopefully working with you. Moving on here, if you guys love what we're doing here at the Real Estate Investing for Cash Flow podcast, please take a moment and subscribe to the show if you haven't done so already. That way you get notified when all new episodes come out. Also, if you feel that it adds value to you and your business and you haven't done that, please leave a rating and review on the show. It really helps us attract awesome guests such as Joe here to the show. And then lastly, just want to remind you of the free 30-minute phone call I offer each and every week. This is where I set aside 3 30-minute time slots to jump on the phone with you, to connect with my listeners, okay? Been doing this now for 6 years. I've spoken with hundreds of you. It's a real exciting time. I get to, really open up your business. You get to ask me any questions you like about real estate investing. And honestly, guys, it doesn't matter if you're brand new to the business or a seasoned pro that's got more experience than I. I always like meeting new folks that share the same passion for real estate investing that I do. To actually schedule that call with me, go to my website, kevinbupp.com. Again, kevinbupp.com. And so now, guys, without further ado, I'd like to welcome our guest here for today's show. Joe, how you doing today?
Doing great, Kevin. Thanks.
Yeah, thanks for joining us here. I'm very excited to have you on. Unique times that we find ourselves in here today,
Sure.
as we record this. So just to give you guys some additional context, we're recording this on October 27th. So more than likely, you're probably sometime in November or possibly even beginning of December when you're listening to this. So just again, want to make sure that you understand when we're recording this, because it seems that times are changing day by day and week by week now. And so excited to dive into your business, Joe, learn a little bit more about it, dissect it, pull back the curtains, however you want to label it. Excited to have you here. But before we, I guess, go into the kind of nitty gritty of Recessions Partners, maybe tell us a little more about yourself, kind of your background, and how you found your way into the real estate space.
Yeah, well, I'm speaking to you from Modesto, California, home of Star Wars was invented here. George Lucas is from here. We're in Central California, so we're about an hour outside San Francisco. We're about an hour south of Sacramento. We're about an hour north of Fresno. We're sort of in a spot people wouldn't think of a lot, except that there's 5 million people in the Central Valley. So it's by most that's like the size of the state of Tennessee almost. So there's a big deal. People think of California, they think Silicon Valley, San Francisco. Turns out there's 5 million people right in the middle, and that's where we work.
Mm-hmm.
I'm from here. I have a business partner of 35 years. A friend of 35 years who's been a business partner for 13 now. And we grew up here. We both went off to college. Both came back and worked various jobs. And then we both found ourselves at working at a company for a guy that owned about $80 million of commercial real estate, mostly office, mostly class A-ish office. But after about 3 years, in 2008, I felt like I hit a ceiling. I didn't want to work for someone the rest of my life. He had already left a year earlier, but we decided to start a business. And in 2008, so right in the middle of the Great Recession or thereabouts, I called my wife and I said, quitting my job, I'm starting a business with Ryan. And I was newly married at that point, about a year in, and she was not happy.
I can imagine. Yeah, you talk about some stressful times. 2008. The world, especially some parts of the country, got affected a lot more severe than others. Florida. Yeah. I always call like Florida, California, Nevada, Arizona. They were kind of like the ground zero states that, as far as real estate's concerned, that got much more severely impacted than a lot of other states throughout the U.S. And so, yeah, you were in one of the ground zero states.
Yeah. So I started in commercial real estate in 2005, which was, hot market, and then rode it all the way down and then all the way back up. So in 2008, when I talked to my wife, it was December 8th, 2008, and I told her I've got enough money to pay the bills through Valentine's Day. And that was how we started. And we started out in doing some consulting for a large local property owner. And then we moved into brokerage. And then we moved into property management. During the downturn, we sold lots of REOs as commercial brokers. So, I would be the first guy that would inform the dentist that he was losing his office and that I represented the bank and that I was going to be selling his property, or shopping centers. And what was really powerful about that was understanding how banks work, but at the same time, using empathy to connect with property owners, but also seeing the mistakes they made, how they got over levered, how they lost the vision for that property. But in 2013, we had a listing in San Leandro. It was a Jamaican restaurant on the bottom and an apartment on the top. And we had it listed for $350,000, and no one wanted to buy it. And no one wanted to buy it. So finally, we just put some friends and family money together and bought it ourselves, and recently sold it for about 3 times as much. But that was 2013, and then 2014 we said, well, that worked pretty good. Let's do 2 more of these. The year after we did. By 2018, we bought our first shopping center, $12.4 million, and then we bought a second shopping center, about $12 million again, 11.5. So the first 9 deals we did were all syndications, where we said, here's the deal, it's great, here's why. We went to a group of people, increasingly group of people. At first it was 3 investors, worked up to about 17 by the time we did that shopping center. Over those 6, 7, 8 years, we built a track record that people cared about. And then in 2018, I sold my last building as a broker and pivoted fully to investor. And so since 2013, we bought $154 million worth of assets. Mm-hmm. And it's been a great ride.
All right. I appreciate that background. I want to back up a little bit because, you condense that in a few short minutes. And so I want to unpack it a little bit. Back in that first property, I think you said 2013 is when you bought the mixed use with the Jamaican restaurant and the multifamily property on top. It wasn't selling. So 2013 was kind of a unique time. We were still kind of on our way, digging ourselves out of the hole. Things were picking back up again. Banks were getting more comfortable with lending, but I wouldn't say that the world was comfortable yet. We were still kind of uneasy, just not knowing, if, is this going to happen again? Are we really, trending towards the positive or what? Anyway, so that property wasn't selling. You had it listed, you just weren't garnering the interest by other, respective investors. And so what was the opportunity that you and your partner saw that others couldn't see? That made you move forward, that gave you the comfort to move forward, knowing that it was a solid investment decision?
Sure. Well, I'll say the next one we bought after that was a Frankly, it had a bar, a tattoo parlor, and it was like the bigger theme here is initially the first 2, 3, 4 deals we did were retail strip centers, and the opportunity with that is that these are mom and pops. If one tenant goes out, another can go in. They're local people. These aren't franchises. This isn't investment quality at all. These are hair salon type people. So I'm trying to remember back to the 2013 deal. I believe, as I recall, rents were just really low. The tenant was mismanaged. He wasn't, because he rented both. He lived up top and had the Jamaican restaurant on the bottom. He wasn't paying on time. So what we brought to that property was capital and leadership. At that point, 5 or 6 years into the business, having built a business from scratch, having hired and fired a few people by then, normally what we do is we lead with capital and leadership. So that means step 1, paint the building, establish something new. Step 2, during due diligence, hear the tenant out, listen, understand their mission, let them know we're partners. We're partners. You're operating a business. We're operating a business. You can't do without us. We can't do without you. But it's a mix of understanding their vision and helping them accomplish it. Usually that means putting in some capital. Hey, for Clive, some part of it was like almost condemned. Like not condemned, but it needed some major repairs. And I mean, this was our first deal in 2013. So we led with capital, about 25 grand. We fixed up his spot. We showed that we cared, but we also we signed a new lease with them, a new 5-year lease. And we showed that, hey, we're going to lead with capital, but we have expectations here, and your rent's going to start here, and over 5 years, it's going to get to here. And it went well.
The point I was looking to extract was, there was many others that passed over that, and there was something you guys saw there. I mean, I personally believe that the most successful commercial real estate investors are equal parts visionaries, right? They can see what others can't see. They can see an opportunity. They can, visually unpack an opportunity where others can't. Other people just pass over it. And so there was something again that you guys saw there that others didn't. I think again, you were a little bit more intimate with the deal, being that you were on the sales brokerage side. So you understood the tenant a little bit more, you understood his business, spent more time around it. And, as a result of that, got more comfortable. Obviously, I'm assuming that's a big part of it. But again, it really comes down to the visionary traits that, the most successful entrepreneurs, not just real estate investors, but entrepreneurs have. They seem to always, rise to the top amongst the others that are just fairly mediocre. So that's exciting.
I think all those REOs we sold, call it 30, 40, 50 bad buildings that we sold in 2008, 2009, 2010, 2011, 2012, 2013. I mean, I'd been through so many bad buildings that I saw this building. Well, and my business partner, Ryan, we saw this building. We looked on Yelp. The guy had great reviews. The guy knew how to cook. We ate, step 1, go eat the food. Like, you might not want to get a tattoo, but like go experience the thing and understand, like, our real estate is a people business. It is run because of the people who care about that business. So if you understand what they're doing and what they're trying to accomplish, and understand how your piece of capital can lead to a good ROI that leads to a good ROI for them, you can get there together.
Yeah, no, absolutely. I agree. And let's, I'd love to chat about I don't know if it's the elephant in the room, what have you, but again, your team specializes. I know you have multifamily investments as well, but one of your, or I guess 2 of your big specialties where you place a lot of emphasis is on retail and office building investments. And so I'd love to start with the retail side of things. And
sure,
again, it depends on what side of the table you're on, but generally speaking, retail has been changing a lot over the last decade. With the growth of e-commerce platforms like Amazon, now Walmart's big competitor, what have you, and it's some people would call it an apocalypse. I don't think that's a good term for it, but it's there's been these major shifts happening now for many years, and the pandemic really has, I personally believe it's doused, like jet fuel onto the problem, and it's really accelerated those that were already struggling, the brick and mortars that were struggling. I had a list here, and it's probably outdated a little bit now. I don't know where the report was from, but as of 2020, retailers that have filed for BK, Neiman Marcus being a big one, JCPenney's, Brooks Brothers, GNC, J. Crew, Pier 1. There's many others there, I'm sure, as well. There's also many retailers that aren't paying their rent. I don't have an updated list as of like a month ago as to, some of the trees that have made us start paying the rent again, but some of the big ones were like Cheesecake Factory. They weren't paying the rent. Foot Locker,
Yeah.
H&M, Old Navy, some big stores that, probably made up some big footprints in some of these retail centers. And so, is I guess to put it more bluntly, do you feel that COVID-19 is the nail in the coffin for traditional brick and mortar retail, and if so, why, and if not, why?
So there's a lot there too, and
there's a lot there. Yes,
and let me turn the tables and unpack that a little bit. It starts with investment philosophy and investment principles. A really core value, or value add investors, is you make your money going in. So you have to pay the right price. So as value add investors, we are activist investors. We go in and create value, and we use that as our both to generate our returns, but also as a margin of safety. If you go in and attack a property with a plan and increase its value by increasing its NOI 15%, number one, you've just created great upside. But number two, you've built a buffer against attack. Something goes wrong, something you didn't see. Okay, well, we just added this piece of value, and we wouldn't have bought it if we didn't know how to add that piece of value and have a plan to add that value and know how we were going to execute. But now we got that margin of safety, which buffers against problems. One of the most important metrics we use is replacement cost. How do you know you bought the right price? One of the number one metrics we use is we try to buy buildings at 40 to 45% of replacement cost. So if it costs $350 a foot to rebuild that building, we want to be at 40% or 45%. It's hard to go wrong when you buy something at half price, especially but then, all right, so then you start talking shopping centers. So we got this one metric, that's a piece of safety. But number two, there's like functional obsolescence. Some of these centers, it's never going to be more than 80% full. That's your new full. Like, hey, it's at 70% occupancy right now, and we think we can take it to 80%. Okay, that's full. We wrote our model that way. We didn't think we were going to reinvent it to this. Also, a big, we're contrarian investors, and a big part of that is this: wherever the crowd's running, I want to run the opposite way. We often say we want to run towards danger with an eye for the exits. Runs one way, you're hosed if you follow that group. You run the other way, you might find a fire escape. And we're not doing a lot of retail investing right at this moment. We are doing a fair amount of office investing, which is also, a concern area. But the point is, whatever everyone's afraid of, that's what we're going to allocate part of our portfolio towards thinking about that. So with retail, it's very hard to time the market. Buildings exist in core locations. Something is going in them. And in fact, if you drive around retail in your city, especially the located stuff, the well-located stuff, it's full of something. Something went in there. I mean, worst case, an office went in there, a warehouse went in there, something went in there. It might not be achieving, traditional high-end retail rents, but we're not going to buy something that has a plan to achieve traditional high-end retail rents. We're going to buy something that says, well, that's a warehouse now. What are our warehouse rents? So you can't beat the locations. These buildings are all going to be full of some. They are now full of something. But as far as like Dress Barn or malls, yeah, that's not a key part of our strategy. What works well, and I heard another of your guests talking about this, is local tenants. Like, it's hard to trust a corporate tenant out of New York who can file bankruptcy and stop paying when they feel like it, or when their shareholders decide it's the right time. But you can look, the owner of that Mexican restaurant in the eye, or your team can, and there's a pretty good likelihood they're going to come every day, and they're going to be very innovative in figuring out how to stay open. Right now in Stanislaus County, retail is closed. But guess what? They've got tents. They're out in the parking lots. They're hustling, and most of them are paying most of their rent. One last idea to this is that shopping centers are the new mixed use. So the ones we own have medical in them. They have government services in them. They have offices in them. We're a few miles away from a shopping center we own, and it's 79,000 square feet, but it only has four restaurants, a nail salon, a dialysis, and it's 50% government, Veterans Affairs, and the county, so federal and local. So it looks like a shopping center, but it acts a lot differently from a shopping center. In fact, we're collecting about 93% of all rents there because of that.
No, that's great. I appreciate that. You made a comment that, you're not putting a lot of emphasis on retail today, and, most of your time and your energy is being spent on office. Is there what are some of the different reasons, to that? I mean, that you've shifted the focus? Is it that, it hasn't been long enough to really see what the fallout's going to be in the retail space? Are you not seeing the opportunities present themselves just yet because it's, again, too soon? Or is it all the above? I mean, what are some of the primary reasons? And I guess in addition to that is, do you foresee a time in the future that you guys will jump back into retail?
Sure. So some people are asset type specialists. We're not. We're geographic specialists. So we're asset allocators. So we look at the whole piece of the pie in our geography for our 5 million people, our 5 million underserved people. This includes Sacramento, Fresno, Bakersfield, Modesto, Stockton. And we say, what's the right mix? We've done industrial. I mean, recently we own shopping centers now. We own office buildings now. We own apartments now. What's the right mix now? And for next year, how do we want to asset allocate? And for next year, so this year we purchased $80 million in assets. Next year, I expect we're going to try to do 100. And so that J curve of like buying 154 million, you can see how fast it's accelerated. But next year, I expect will be about 40% office, 40% multifamily, and the remainder either industrial or retail. So some opportunistic thing we haven't seen yet. I apologize. What's the rest of that question? I went off in a direction there.
No, that's. I think you kind of answered it there. It's just more of a, why you're not buying today, and what do you foresee in the future as to how much of an emphasis you'll place on the retail side of things. And so let's.
Office is more scalable. Retail is more individual. To place that to buy that level of assets, you can't go look the Mexican restaurant owner in the eye and reason with them. That was a great strategy 3 years ago. And we have a team of 15, so other people on our team are doing that. But as we look at what we did this year and what we're planning to do next year, we begin to think more in investment themes rather than individual tenants. So certainly the future of office is a really important theme for us. And for Sacramento, where we've got a lot of population in migration, and we've got 25% of jobs that are government, state tenancy, we think office looks like smaller footprints in secondary submarkets. We think that footprints get about 15% smaller. So like we're closing on a 80,000 square foot building next month, and it has 30 tenants. So these aren't 5, 7, 10,000 square foot floor plate or spaces. These are 2,000 and 3,000 square foot floor spaces, financial planners and lawyers and property managers and hospice care, headquarters and accounting and those sorts of things, where it's not like Twitter where they can just say, hey, everyone will work from home. They're just not set up for that.
Mm-hmm. So let's talk about that particular deal. 30 different tenants. Obviously, there's been disruption probably with each one of those individual tenants as far as are the employees working from the office? They work from home? Is there a hybrid approach? How are they handling it today versus how they were handling it 6 months ago? How do they intend to handle it 6 months, down the road, as far as, is everyone going to be back in the workplace or not? And so is it a tenant by tenant interview process to get a general gut feel as to what their future intentions are? Because ultimately, obviously, the risk being, when that, 1 year term comes up or 3 year term or 5 year terms that they don't renew, so how do you mitigate that risk?
Well, back to our core principle, which is we lead with value. So this property, it's in this property, it needs an upgrade. So when we get there, it's been owned by a owner that hasn't been paying attention for about 15 years. So when we get there, suddenly the lobbies are going to look a lot better. The building is going to be painted a modern color scheme. Landscaping is going to go up. There's a courtyard with a fountain that's not running. It's going to start running like crazy. There's going to be orange umbrellas. When you walk up to the property, visually, you're going to say like, wow, this is different than what I expected. These guys are doing something different. Secondarily, it's a negotiation, but our job is to start, like with any negotiation, with letting our tenants feel heard. We're not going to be able to force them into some sort of box. And if we do, it'll backfire. But currently we're working on 3 renewals in that building. And what we're hearing is, we want to be 10 or 15% smaller. We want to sign a 1-year lease because we don't know what this is going to look like. Okay, no problem. Sort of. First off, when you have smaller footprints like that, it's a little bit easier to move a wall one way or another. It doesn't cost that much. And we won't do that for a 1 year. That's got to be a 3-year deal or something like that. Number 2, when you reduce their size footprint, their total dollars go down. But my goal is to fill the building at a higher rental rate, 10 or 15 cents a month per square foot higher. Well, this is my chance. We're going to make a trade here. We're going to give your total dollars are going to go down by 20% or something. Let's call it 15% because I'm going to make the trade of, we need to up your per square foot rate in this process. So the building's cash flow well. We're buying it at about an 8 cap. We've got a 15% internal rate of return projected on about a 7-year hold, which fits our model. It's not, a grand slam, but 15% is 15%. But my job is to lead this building through the churn of the next 5 years. In my opinion, all the office space gets filled, but it gets filled a little bit differently. And there's a lot of churn in the meantime. If you're set up for it, this is the expert zone. This is where professional investors aren't buying, at the top of the market. They're being strategic and finding the right buildings with the right problems, not the wrong problems. And now's a good time to buy, like this building. Most buildings we're getting about a 10 or 15% discount, closer to 10 over a year ago. But 10% on $12 million, that's the money.
Yeah, no, that's significant. What does the capital look like on this particular deal? Not the equity side, but more specifically the debt side. Again, I know that a lot of lenders, again, starting in March, looking on the call it the agency side on multifamily space, Fannie and Freddie started getting cold feet. They lowered LTVs. You required a significant amount of reserves, what have you, and this really started scrutinizing deals a lot harder than what they had in the past. CMBS is it's not dried up; it's slowly coming back, but I mean CMBS is they're in a world of hurt, generally speaking, because they've got a lot of distressed distress notes tied to hospitality and retail, and then you got the local banks. And so again, what is the appetite out there right now? Maybe you can speak to this particular deal. What's the appetite look like from the lending side of things?
So first off, we don't have any CMBS debt. Our strategy has been to always be willing to pay a little bit more to avoid that. We want a banker across. This is a margin of safety thing where we want to be able to go look someone in the eye and work something out. We've never had to, but we would want that ability to, rather than trying to negotiate with some lawyer somewhere that follows just whatever the rule is. So we use a brokerage firm out of Sacramento that's outstanding. In this case, we had 4 offers. They were all regional banks, actually one national. We got to the end with a regional bank and Wells Fargo. And one thing we've been doing in this time has been getting a little bit more time in escrow, generally 75 days instead of 60, which lets us, like Wells Fargo works a little slower than this local bank, but they're at 3.05%. I believe this one's a 5-year term with an option to extend. But in that first 5 years, that's where we're adding most of the value and we're lowering our LTV. And I believe we're at 65%. I think we're at 68% loan to cost. Purchase price plus improvements, get the loan on that.
What is the business plan after you've added value to it? You obviously got a 5-year term. You could either renew. I'm assuming there's going to be a reset on the rate at that point in time. But is it to refinance or extend that term or to exit out of that property? What's your typical game plan with a deal such as this one?
So our fund allows for a 9-year hold. IRR gets better as you get shorter. Largely, I'd say 50% of what we do is we're in the flip business. We just flip large office buildings, and that happens to take 3 to 5 years. You might flip a house in 2 months, but if you're going to flip a large office building, you better have a 3 to 5 year plan. And so in this case, strategy would be go in, add value. A piece of the value came from getting a very substantial COVID discount because the pendulum's away from office right now. So that's a big piece of value. And then taking rents up about 10 or 15%, because rents are even now quite a bit below what we believe the market will support. And then, sell it at a similar cap rate or a post-COVID cap rate after everyone is vaccinated and a little less scared of this, and Zoom has done everything Zoom can do, and floor plates have been moved around, and now instead of 30 tenants, we got 36 tenants, on 3 to 5 year leases. I think in 5 years we'll be in a good spot.
Well, let's talk about that. You had an interesting segment on your website there as a video you and your partner did. I think the title of it was like, by the end of 2021 or in 2021, what will the world look like, or what will work look like? Not the world, but what will work look like? And it was, it was related to the office sector, more specifically, which way will the trends go? Are they going to continue with the telecommuting environment, or are they going to go back to, what we remember to be pre-COVID, or is it going to be a hybrid of the two? What's your crystal ball tell you? Again, I know that these are all opinions, right? No one's got the crystal ball. If we did, we probably wouldn't be on the show right now. We'd be somewhere else doing something. But
my first opinion is the media exaggerates by about 20%. So, and when you see all these headlines, you literally think, like, who would ever go to an office ever again, ever? And that's great. That allows us to get better purchase prices. Here's my my opinion. When I say Ryan and I spend a lot of time in our team and arguing this through and scenario playing, and we built Excel models and all sorts of stuff on this. But the gist is this: in America and in the world, it is an extremely competitive environment. 70 to 90% of businesses go out of business in the first 5 years. And if you survive the first 5 years, 70 to 90% of those businesses go out of business in the next 5 years. What that means is when you come to work, you had better bring your A game. You better come here like ready to crush it, or you just won't be around that long. And that requires innovation. That requires collaboration. I mean, you better pivot. You better invent. You better figure stuff out. But when you're doing this activity called work, it doesn't work well if your kids are walking in the door saying, "Dad, I need help." If the dog needs to go for a walk, if my wife is asking me to hang a picture, I can't go buy giant buildings and make them better if all those things are happening. And for that reason, a portion of the office will continue to exist. And here's why. Office buildings only exist because of the people that are in them. Just like houses exist because people need a place to live, office buildings exist as one of the most streamlined ways to accomplish growing an organization. Collaboration, teamwork. Here's a really big one: culture building. Huge one, culture building. A lot of being a part of scaling a company is putting the identity, the ethos, the brand, the culture, the DNA of your mission, like right on our website. So we create environments to transform people's lives. Like that could be a statement, or that could be like, a really big deal. But to get that into someone's brain, a team member's brain, an on-site person's brain, a property manager's brain, I mean, you need a lot of team building. You need a lot of hours in the office. You need to express and show integrity and intention and intensity. and try doing that over a Zoom call. Zoom, I think, is the office is changing, no doubt. More people are going to work collaboratively from other places. We have consultants we work with daily. One of our best analysts we work with lives in Detroit. I mean, I talk to her every day. Like, we're bonded. We work together really well. But for me, that means the office is going to reduce in size by 20%. And of course, if you're a giant company, that might be different. If you're a tiny company, you can probably reduce a little more, because your systems and processes are so well defined. If you're Twitter, you've got a core group that's changing the world, and you've got a lot of people that are writing code. Like, that can probably be done in a lot of places. But if you're a smaller business, like the office footprints we're buying, you're just not quite built that way. Every person matters, and they better be paying attention.
Back to the media, them over exaggerating by whatever it is. I mean, they just let's call it, they over exaggerate all the time with any topic, whatever it might be. Again, really hitting on how the pandemic has just been crushing commercial real estate, blah blah blah. Have you guys seen any direct impacts correlate to your investors? Meaning, like, any trepidation that might not have existed before with a subset of your investors that are now scared to put money into either office or retail, what have you, or has your track record been able to overcome that fear?
Well, last year we bought $27 million in assets, and this year we were able to buy 80. So I would think, I don't know, someone thinks we're doing a good job.
Good answer.
But for most of our investors, we are not their primary source of, we're a diversification piece for them. But they're nervous about the stock market. They're nervous about equities. And most of them see a podcast like this or know us. Most of I would say 80% of our investors live within 3 hours, or certainly live in California. We've met them. They have a sense of who we are. And what they think is, these guys know what they're doing, they've got integrity, and they're working a plan. Like, when I go put money into some stock, I don't know those guys. I don't know who they are. I don't know if they have integrity. I don't know what plan they're working. I don't know what their big investors are saying. But these guys, they know how to attack an office building or an apartment complex and make it something better and more valuable. And it seems like, number one, I don't think real estate's physical, so it usually never goes to zero. Number two, these guys are leading with a plan to add value. So, and they got a track record, and I know, this other person that's invested with them for years. Let's try it. And we often tell people, I guess there's a little bit of a plug, sort of like, I heard just at the beginning, but we tell people put in a small amount and in the first fund and get to know us. Almost everyone, I can't think of a case where it didn't, said, that was great, let's do that again. So
yeah, it's all about doing what you say you're going to do, right? that fixes a lot of things, potential problems, that is. There's a case study. You had some case studies on your website. One that just caught my eye, and I don't know, what year you did it. I'm sure you can share that, but it was the post foods plan, and
Sure.
More specifically, anchoring back to what we talked about in the beginning of the show, regarding being a visionary, right? Seeing opportunity where others don't see it. That, and I don't know the entire context of that deal, but what I saw from the outside looking in, and correct me if I'm wrong, was it seemed as though you bought the plant for the there was some value to the actual components, the equipment inside the plant, and then also subdividing that property and selling it off to other investors to redevelop. I mean, was it an operating plant that was creating cash flow, or was it a vacant building?
Vacant.
Okay.
So this is one of our earlier deals. We were a third of the capital, and we had a 2/3 JV partner in there. We bought it, as I recall, for $4.6 million and sold it for $6.4 million. And the upside there. So first off, it's a 280,000 square foot facility. It's huge. It was on about, I didn't know you were going to ask about that case study, but it was 80 or 100 acres. I mean, a giant piece of land. And they made honey bunches of oats there. They made Tang there back in the day. They made Raisin Bran back there in the day. And by the time we got it, it had been Post Foods had it, and they were making cereal there, but they had decided they didn't want to be in California. They consolidated back to Michigan. I think that's thanks to the Atkins diet or something like that. But this property came for sale. And the visionary piece here was, all right, we're getting a giant building at a pretty small price. I'm trying to remember the purchase price, but I mean, it was really cheap per square foot. And it's in a good growing location. It was surrounded by new warehouses, but this building was weird. So it was, regular investors who are buying the tops of the market are like, I buy warehouses. They look, they have 34-foot clear height. They're 500,000 square feet. Well, this one had, 280,000 square feet, but part of it was stacked 5 stories tall. Part of it wasn't. So what we did is we thought, okay, let's value all the pieces. Well, there's 125,000 square feet on the first floor. That's pretty darn leasable. And there's an outbuilding here that's pretty leasable. And we've got a lot of fenced yard space. This should be a trucking company. And wait, we got a bunch of old equipment. What can we get for that? It's mostly stainless steel. What can we get for that? And hey, we got this giant piece of land. How do we segregate this and sell both of them off? And the challenge in buying real estate is you have to make a plan that you think is accurate, and then you have to have backup plans. And we went into that thinking, okay, we're going to do all this leasing and then carve this piece off and sell this at a cap rate and sell this, individually. In the end, we ended up selling the land to a subsidiary Gallo Winery, and they've now built new warehouses on it. They were already moving that direction. And then we sold the building to a manufacturer, and they're now manufacturing in there. But that ended up being the core play was separating the properties off. But
yeah, no, the interesting component there was getting back to the visionary status of buying an asset below replacement costs, significantly below replacement cost. But in that situation, there was no existing cash flow. So like it's how do we make something out of not nothing, but like an incredibly unique property that there's not thousands upon thousands of companies that would be a good fit for, right? And so like it's like digging a needle in a haystack to repurpose that existing building. But how do we dissect it, pull it apart? Where are the valuable components here? And how do we mitigate the risk along the way? You don't have cash flow to mitigate those risks. Like it's a plan A, plan B, plan C, and then what's a plan D if all that doesn't work? And how do we get our money back out of it and still churn a profit? So anyway, I wanted to bring that up because
the core margin of safety there was you make your money going in. Our price per square foot purchase price was outstanding. Last year we bought and sold in the same year these 180,000 square foot shopping center called Century Center Modesto. We bought it. It went through foreclosure, and we bought it in auction, and we got it for $67 a square foot. Originally, a large REIT had valued it at $40 million in a refinance a few years ago, but shopping Rayleigh's went out. The grocery anchor, Bot Chalk's, an old retailer, went out. So they valued at $40 million. We bought it at about $11.2 million. We carved off a bank, a Chase Bank branch, sold that for about $3.2 million. And then we sold. So we led with value. We painted the whole center. We redid all the parking lot. We took the old God Shocks. We demised it in half, and we leased 25,000 to a large government medical group, Golden Valley Health, and high credit. We put in several new restaurants. We renegotiated leases with a bunch of other tenants. We kicked out a few of the tenants that were toxic. And in the end, our total exit there was $24.75 million in a year. That's the best deal we've ever done. I wish I could just replicate that over and over again. But in 1 year that happened. It also happened that it closed in January 15th, and COVID hit like March 15th. So.
Wow, good timing.
But it was cash flowing. It would have been fine. But if you make your money going in, sometimes things work out.
Yeah. So lots of great information you've shared here today, Joe. Really appreciate you coming on. Lots of golden nuggets. But now we enter into what I call the golden nugget segment. So I'm going to ask you for one more before we wrap things up here for the day. And so, what is that one final golden nugget of advice or wisdom that you could leave with the listeners here today that might inspire and motivate them as they progress in their own real estate investing career?
Yeah. I'd start with the idea that success favors the bold. And if there's a lot of value in just taking that next step. There's a great book called The Hard Thing About Hard Things. And the core value there is, if it were easy to get from A to B, that's a commoditized thing. It's going to pay very poorly. In this business, there's very rarely a clear path from A to B. But I've been doing this now since 2005, so 15 years. After a while, you develop four, 5, 6 different breadcrumbs that you're able to spot. And after a while, you're able to make a path to get from A to B that others can't see. There's 3 parts to this business: opportunity, capital, and team. And where I see people going wrong is that they're personally good at 1 or 2 of these things, but to scale, to create tremendous wealth, tremendous cash flow, you're going to need all of those things, which means you're going to need partners, which means you're going to need teammates. And so one thing I've seen with this business is it works if you're a small operator, and it can work if you're a big operator. It gets a little bit messy in the middle. But so the last piece of advice I would say is there's a lot of great books on. My favorite one is Traction. I'm drawing a blank on the guy's name, but once we implemented Traction in our company, an entrepreneurial operating system, it was rocket fuel. Like, everything started to click. And then as we grew, we were able to hire 6-figure people and managers that really knew stuff, that had 30 years of experience. And now there was a wind at our backs. Even when I'm asleep, other extremely talented, experienced people in our company are solving problems that don't have to take up my brain share. So I can think about asset allocation and value add and investment themes. And that's really powerful.
No, that's great info. And yeah, we're a huge proponent of Traction, Gene Wickman, and EOS model. We implemented it in our business about 2.5 years ago, and definitely was a game changer. So there's many different, operating systems out there, you could say, but it's one that resonated with our group and has really helped us get much more aligned as a team, and even find the right talent, right? Get the right butt in the seats and the wrong ones out. So yeah, it's definitely been a game changer. So Joe, this has been a lot of fun having you here. Really appreciate you coming on the show. For those that want to learn more about you and your group, what's the best place to find you?
Sure, GraySetaPartners.com. We put a lot of time and effort into podcasts. We've done about 20 of them now. So the sort of thoughts I've been sharing, we've distilled those down. We wrote a great piece called The Future of Work. You can find that on our website. And we put out a newsletter every 3 weeks called Gray Seta Insights, where we got the idea from Howard Marks and Oak Tree Capital, where you share themes that you're working on. And it's pretty fun if you want to see little nuances that we're thinking about. So.
All righty. Fantastic. Well, thanks again for joining us, Joe. It's been a great time having you.
Thank you, Kevin. Talk to you soon. Bye.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buck, wishing you huge success. You take care.
Congratulations. Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.